Hello, this is the lesson on capital gains and losses. As always, refer to your Pub 4012 in tab D and Pub 4491. They are very useful resources. So why do we care about capital gains and losses? Basically, they're taxed at lower rates than ordinary income. Our taxpayers normally have a capital gain tax rate of 0 to 15%. Higher income ones are 20%. So capital gain tax rates apply to long-term gains and also to qualified dividends. Short-term gains are taxed at ordinary income rates. And then capital gains or losses only occur when the taxpayer sells capital assets. So what is a capital asset? It's something used for personal purposes or investment. A business asset is not considered a capital asset. Now, the IRS considers your home and other types of non-investment assets only if you have a gain on it. If you have a loss on it, too bad. So the government's a profits-only partner. Now note that a home can be a second home, it can be a houseboat, it can be a mobile home. So things that are not capital assets are business assets, inventory, a rental property, things like copyrights or artistic compositions. Anything that in this category is out of scope. We can't handle it. So a quick quiz. What's capital asset? IBM stock? Yes. IBM bond? Yes. How about a vacation home? Yes, if you sell it for a gain. Rental property? Out of scope for us? No. How about a pleasure boat? Again, yes, if you sell it for a gain. Gold jewelry? Yes, if you sell it for a gain. By the way, gold bullion is not a capital asset. That would be out of scope. Bitcoin or other types of cryptocurrencies. Maybe, but that's all out of scope for us. We can't do any returns if somebody has sold Bitcoin. The IRS reporting requirements. Most people are familiar with Schedule D. That's where you summarize the capital gains and losses. In recent years, the IRS has added Form 8949, which provides detail of the capital gains and losses by different types of capital asset sales. And we'll go over that in a little bit. So in TaxSlayer, you would input capital gain or loss transactions in the federal section, the income section, capital gains and losses. Look in Pub 4012 tab D for the input screens and appropriate instructions. They're very good. TaxSlayer will fill in all the appropriate forms of Schedule D and the 8949s after you input the transactions. So when do we have to report capital asset sales? When they are sold, they get reported, or when it's otherwise disposed, for example, a bond redeemed, or if something is totally worthless. The payer will advise the shareholders, the taxpayers, and report everything that has to be reported to the IRS. So transactions that aren't reported, if it's not a sale or exchange, for example, a gift, a donation to charity of an asset, a bequest to an heir of an asset, those are not reported. Key elements of the sale are the dates it was bought and sold, what it cost, and what it's sold for. Now, most of the time we see this information on broker statements. So we need to read those very carefully. There's lots of small print. There's no consistency in terms of what broker statements look like. And you really need to look at everything there, make sure everything is in scope. Also look at how many transactions there are to decide if you want to enter them individually or group them by category. We'll go over that in a little bit. So in the interview, with the taxpayer, you would look at the forms they have. Do they have a 1099-B, which is the required format for reporting sales of capital assets? Sometimes there'll be a corrected form. Always follow the broker statement and use that information. If the taxpayer says it's incorrect, that's up to them to provide the appropriate information. So review all the forms, confirm that all the required information is there. If there's no cost basis, then you have to have a dialogue with the taxpayer about what that might be. Otherwise, it's going to be a zero cost basis and the entire sales price will be taxable. Real estate is reported. If it's reported, it'll be on a 1099-S. That's a separate lesson. Again, confirm everything's in scope that you can actually do the tax return. So we can do tax returns for sale of stocks, including mutual funds and the new exchange traded funds. We can do sale of personal residences. We can do sale of bonds, municipal bonds, for example, or corporate bonds that mature with no gain or loss. A lot of them are reported on a brokerage statement. Now, there are some complications with bonds. If they were bought or with a premium or a discount, then that becomes complicated, and we normally can't do those. We can do capital gains and losses on a K-1. We can do capital loss carryovers. We can do wash sales. Recall that a wash sale is if you sell a stock for a loss and then within a short time period you buy it back again. Those become disallowed. They'll be reported on the brokerage statements. Worthless securities, we can do those. Inherited property and gifted property. Now, the taxpayers may have to provide the information on the acquisition date and basis for those last two. Again, out of scope, we can't do some of these complicated things here. So the cost or the basis of the share is the amount originally paid. We use these terms interchangeably sometimes, cost and basis. Adjustments to the basis when you have individual shares would be the commissions or purchase expenses and other types of things. The IRS has required reporting to them of basis since 2011, and you'll often see the term covered or non-covered security. So a non-covered security was probably bought before 2011, a covered security after that. Covered means the brokers are required to report the cost basis to the IRS. Non-covered means they don't have to do that. Now, most brokers will show the cost basis to the owner, even though they don't have to show it to the IRS. Sometimes the basis is unknown. We talked about that before. Again, the IRS says if you don't know what it is, it's going to be zero. If we file a tax return with a cost basis of 0, and it affects the tax return if the taxpayer knows what the basis is, then we can do an amendment. Stock splits or dividends, just for information, if a stock splits, the taxpayer will get additional shares. The basis of the old shares is spread over all of the shares, the old and the new shares, and the date acquired stays the same. So, for example, taxpayer bought 100 shares for $5,000 in 2006, so the cost basis per share is $50. And then in 2014, they get 100 more shares to a 2-for-1 stock split. So each share, since the basis is still 5,000, is now $25 per share. And the date acquired stays the same, 2006. Dividend reinvestments. Shareholders get dividends and the broker reinvests it in new shares. The date acquired for the new shares is a dividend payment date. Luckily, most brokers will do all the calculations for the taxpayer because they can become quite complicated. Inherited property, for your information, it's always long-term, and TaxSlayer has a pull down for that, inherited long-term. Other than 2010, the basis is always going to be the fair market value on the date of the death, or in some cases, it can be 6 months later if the estate elects to do that. The taxpayer has to provide us what the basis is because we don't know. Now, if somebody died in 2010, thanks to our Congress, they made a special rule for that. It's usually the fair market value. However, we can do that if there's no estate tax return filed. However, if the estate does a special election for the fair market value, the taxpayer has to bring us a particular form 8939 in order for us to do it. The purchase date is the same as the purchase date on Form 8939. This is very rare for us. If it's gifted, the taxpayer again has to give us this information. We don't know what it is. There's a couple of ways they can know the basis or the fair market value. It's up to them. If they don't know, we can't help them. Holding periods. So when the asset was bought and sold is important. For individual securities, there's a trade date and a settlement date. We always use the trade date. And the difference between that buy date and the sell date is a holding period. Now, for individual transactions, we would enter the dates on the broker statements. TaxSlayer does the calculations. There's also a drop-down where you can put in long-term or short-term. So, for example, if somebody buys on June 1st, 2017 and sells on June 1st, 2018, is that short-term or long-term? That's actually short-term. It's considered 1 year. If it's sold on June 2nd, that's considered long-term because it's 1 year and 1 day. So it has to be an extra day for it to be long-term. The sales price is going to be the gross proceeds or the net proceeds, depending on whether there's expenses or commissions associated with the sales. Brokers are supposed to use net proceeds. Now, if you ever run into a taxpayer who trades in stock options or futures or is a daily stock trader, they really need to go to a paid preparer. Now, Again, the brokerages will vary in their format for their 1099-Bs. But normally what you'll see is the brokers that they'll divide the transactions based on the codes that are in Form 8949. You'll see boxes A, B, C, D, etc. So for example, here's one where it's box A, which means it's a short-term transaction. The basis is reported to the IRS. There's going to be normally 5 categories. We rarely see the 5th. So box A is going to be short-term transactions. The basis is reported. Box B is short-term transactions. The basis not reported. Box D is going to be long-term with the basis reported. Box E, long-term transaction, the basis not reported. And again, these boxes refer to boxes on the Form 8949. If the broker has no idea about the holding period, whether it's short or long-term, they're going to say it's box X. Again, that's going to be rare. The taxpayer would have to get involved. Now, technically, there are other cost basis types if the taxpayer didn't receive a 1099-B for the transaction. It means it's not reported to the IRS. Those can be box C and box F for the 8949. So if there are a lot of transactions, you probably aren't going to want to spend the time entering them individually. So we can group them into their box categories using the subtotals that are provided by the brokers. Again, in TaxSlayer, you would put an alternate date for the buy date, select short-term or long-term, and just use either the end of the year or any date that's on the broker statement. And then you would enter the total amounts for that particular category, the total sales, the total cost, and total adjustments. Now, if you do that, you have to enter an adjustment code. If you recall, on the bottom of the capital gain capital transactions, there's adjustment screens. Code M means you've summarized them. That'll generate this Form 8453, which means the IRS is expecting additional information. If the IRS wants additional information regarding the summary of the capital transactions, the taxpayer is going to have to send in a copy of the statement with detail along with the Form 8453 that you give them. Again, adjustment entries other than code M, ones we see are code W for wash sales. Sometimes, rarely, if they sold a home, and we're going to exclude the gain, if it's reported, it'll be code H. Again, the Pub 4012 tab D has the listing of all of those codes, and just a reminder, not all of them are in scope. Capital loss carryovers. Hopefully the last year's tax return, they would show that and bring the worksheet that we've computed capital loss carryovers available. If they don't have the worksheet, and last year's carryover was, or last year's capital gain or loss was exactly 3,000, then you're going to have to calculate it manually. If they're returning from the prior year, TaxSlayer will carry over this number for you. In terms of the tax liability, TaxSlayer accurately calculates it based on the appropriate capital gain rates. Again, the capital gains tax rates are net long-term gain, can't be short-term, and any qualified dividends. It will produce The qualified dividends and capital gain tax worksheet, there'll be a copy of that in the PDF printout. That's what the IRS uses to calculate the taxes if there are capital gains or qualified dividends. If you're doing a quality review of capital gains and losses, use the print set that is there available for you. Look at all the Form 8949s, verify that transactions were entered correctly based on the subtotals you'll see in the broker statements, the 1099-Bs. Very important. Usually in the first page of a broker statement will be the total proceeds from sales. Regardless of whether they're gains or losses, it'll be total proceeds. You need to verify that the total proceeds on the Schedule D matches what's on the Form 1099-B, because that's what the IRS is going to look at. Again, confirm that the capital gain distributions on the broker statements also carry to Schedule D. Look at K1 capital gains and losses. Look for any capital loss carryovers. So, any questions or comments, you can direct them as follows. Thank you for your interest.